Hello and welcome to Kitco Mining's Digging Deep with me, Paul Harris. We are at the 2024 Rule Symposium in Boca Raton, Florida. This is the show in which we dig deeper into some of the main mining and exploration news. Joining me today is Joe Mazumdar, editor of Exploration Insights. Joe, welcome back to Kitco.
Thank you, Paul. Thanks for the invite.
And before we start, please note that our conversation today is not investment advice and the opinions expressed are our own and not Kitco's. 7 keynotes, 13 guest speakers, including some of the best and biggest names in the investment industry, and 53 issuers. My colleague, Jeremy Saffron, has interviewed many of them, which will be available on the Kitco channel over the coming days. Joe, what has stood out for you at the Rule Symposium so far?
Well, I came here last year, granted with very low expectations because it's South Florida in July. But I was and continue to be impressed mostly by the attendees and the quality of the attendees, the questions they ask, and also talking to the companies about, people actually being interested in writing checks and actually buying on the back of this. And so they're very keen on the sector. They're very knowledgeable in their own sectors, but also willing to apply that intelligence to what they're doing here.
And they're also getting some good education listening to presentations from Exploration Insights.
We do what we can.
Okay, now this year you presented on using machine learning to evaluate drilling results based on your use of Tacit Vision's AI-based technology that generates a probabilistic, I can't say that, model for resource estimates. Tell us about that and what it enables you to do.
Okay, artificial intelligence has been talked about a lot, and one of the companies that's been doing very well on NASDAQ and that, NVIDIA, is all about artificial intelligence. So if you put the artificial intelligence label on anything, it goes up. That's not what we're trying to do, but it helps. But we're looking at a branch of it called machine learning, where it uses big data, and the big data is coming from resource estimates and the drill holes coming into it. And so as we're trying to point out in the presentation, it is called a mineral resource estimate. And what we're investing in is mostly companies that are pre-resource. And they're doing drilling, we're finding intersections, they're talking about it. And what we're trying to do is say, from your perspective, being a retail investor, or mine, who doesn't have an NDA and I don't know anything more than you do, we take those drill results and try to model what the potential resource is going to be, using this tool to say, this is all the data I have from 440 plus resource estimates based on 5 million different intersections. What does that get me? And so if I use the drill holes from a pre-resource company and I can model it, I can find out where that falls and say, is this an exceptional grade? Is this, and the human intelligence part is going to site, like we do at Exploration Insights, looking at the mineralization and seeing if it's continuous, where we can put more confidence in the actual resource. And that's about culling those 2,000 companies and trying to get to just the companies we want to learn more about.
It was a fascinating presentation, and that will be available on the Rule Symposium app and website for on demand, so people will be able to access that. You also wrote about that in your weekly publication. Some fascinating data points in there. You said the model is based on sort of 480,000 drill holes over the last 18 months, and of those, there was only 17% that returned significant intercepts. Now, to me, I thought that was quite low, but in conversation with you, you said you were surprised it was that high.
Yeah. Well, I just want to correct. The database is based on, several million intersections. What I pointed out was 485,000 intersections over the last 18 months. Those intersections would be in the database, the ones that generated resources. The other ones probably wouldn't. But you're right. Like when I looked at the number 17%, I thought, wow, that's much better than I thought. But again, I don't know what the definition of significant was with the S&P Global Market Intelligence, but I would say that would be a top number in terms of your chances of a drill program coming up with a highly anomalous result.
How are you going to use that in your investment strategy?
So like I was saying in the presentation, like when I did Fosterville and when I owned it as Newmarket, if I had that data of understanding how exceptional that grade was in terms of a global distribution of resource estimates, I would have held at least 50% of my investment in new market in Kirkland, because as we know, the truly exceptional deposits like Long Canyon, like Timok, and like Fosterville, they don't get acquired once, they get acquired several times. And that's what happened between Crocodile Gold, Newmarket, and Kirkland. And eventually now Agnico has the deposit. Timok was Nevson, Zijin, and then you got multiple bidders for it, and you get a really good price because there's, it's rare. And so looking at the distribution, I would have kept it. So that would have been a decision I would have made. That would have been an application of the tool. Another application would be on something that's a highly variable deposit, like the Phoenix deposit with Rubicon. Prior to their first resource estimate, I would have known that the deposit was highly variable, and I would be looking at what's my downside. And I would have known from the graphic that the numbers they put on were outside the actual distribution curve. So I know that everything that they're talking about is P99 plus. So all I have is downside. So then I would have been taking money off the table if I owned it.
One of the things I sort of picked up on in your presentation is that to a greater or lesser extent, variability in an ore body is the enemy more than whether it's high grade, low grade. It's the variability.
Exactly. And the problem is that, like I said, like it's a mineral resource estimate. It's not the truth. The only truth is once we mine it out. So what we're talking about, how much confidence do we put in that estimate? The less variable is, the more confidence we could put in that number. The more variable it is, the less confidence we could put in that single deterministic number that they put out.
Given the importance of variability, it's not something you hear a great deal of in the exploration sector. I mean, it's you have the variability aspect in the technical reports, but it's not something you hear. So it's not in the corporate presentation.
When you look at sections in that, what you're looking for is continuity. You don't want one intersection there driving the entire grade, gram meter interval. You want lots of intersections there that are driving the grade. And then you look at the next hole and you see that what we call continuity, suggesting that between this hole and this hole, I can safely assume that mineralization exists. But if I've got a hole here and it's like announced like it's 100 gram meter, but it's like maybe 500 grams, but over, let's say, a half a meter, and it's one hole structurally, I don't know if that's a vertical structure, if it's coming this way, how true the thickness is, and the next hole might not hit it. And so then they have to come in closer, and the closer they have to drill to define it, the more expensive it is, and probably the less of a resource it ends up being, because you can't infer that resource beyond that space.
Okay, fascinating stuff. Now let's talk some mining news. Companies will begin issuing their June quarter financial results soon in the coming weeks, and the expectations are that we're going to start seeing margin growth due to the higher gold prices, which I think averaged about $2,338 per ounce, a record level, beating out the sort of $2,040 per ounce seen in the March quarter. And there's less cost inflation. China's Zijin Mining has indicated it's in for a record net profit after tax for the June quarter of $1.1 billion, which will be a 70 to 80% increase year on year, 30 to 40% higher quarter on quarter. Joe, what are your expectations for the quarterly results?
Wait, when we're talking about Zijin, we're probably more talking about base metals and copper?
Well, that was specifically on the gold aspect, but in terms of the gold sector, what are you expecting?
Well, I suspect, that's what we want. The question is, are they being impacted by costs? And some of these jurisdictions like the US, Canada and Australia may still be impacted by labor. Some other jurisdictions, maybe not so much. We're not getting, we haven't had a big blow up in the oil price and energy costs. And so but there's still issues with supply chains. My concern on if we look at other costs, like on exploration, is that the drilling costs are very high still. And the problem with some of these costs is that they remain sticky, and they don't change as fast as people want them to do. So when it's leveraged to a commodity like oil, yeah, your cost can go down. But if it's labor, hard for that cost to go down. And if that's where most of your exposure is, it could stay there.
If the gold producers are able to show margin growth and putting more cash on their balance sheet, to what extent or not do you think that would be a trigger for generalist investors to get interested in the sector again?
We need two things. We not only need that margin to grow and that cash flow to build. What we also need is that environment where the gold price is going up because real interest rates are modeled to come down. If we get that, then we have more inflows into gold ETFs, which naturally spill over into equities. And so if the equity environment is ripe with expanding margins, we should see a very good beta and leverage between the producers and the gold price. If we don't see and it's only central bankers buying the gold, or not even, and we have a flat gold price, we will not get those people with the eyes on the precious metals equities. And so it'll be like a tree falling in the forest that nobody will care about.
Okay, if gold companies are generating additional cash flow, what would you like to see them do with it? Pay down debt, give more dividends, stock buybacks, buy all the juniors in your portfolio?
Well, the latter. But I would say from their own perspective, if they're not getting any love, then probably going into the dividends would be the way to go. And that way, it's cash for the shareholders, and they could look at it as a dividend stock, and much better than an ETF. Growth right now is problematic just because not only are we seeing cost on the operating side, but we're seeing it on the capital side. And so I think some people, when they do add production, which doesn't change the supply demand, but what it does is it's less risky because the project's permitted, the capital's already been spent, tailing's been permitted, and you could just go from there. So they're willing to pay a 30 to 40% premium, and so M&A might be something that we see. And hopefully that was a good indication that the industry knows that this is a good opportunity. Because if they see the gold price going up, but the equities aren't doing anything, maybe this is still a moment prior to everything going up that they could still get. And I want to see some of these development plays get taken out, like we saw with Oka West and Reunion. Those would be a good sign that they're saying, well, there's just not enough production out there for me to buy, and now I have to go one more step downstream. Okay,
now we're at the Rule Symposium, and one of the company exhibitors here is Hot Chili. They put a news release out this week. They're a copper developer in Chile. They formed a water company to provide a water solution for the development of their Costa Fuego project and other projects in the Huasca region. They're modeling that in certain aspects or inspired by Antofagasta Minerals, which recently sold all the water rights to its Centinela copper mine to a third-party water utility, which is going to save them about $380 million on the capex of building their second concentrator. Seems to be a smart move by Hot Chili to do this. Well, what's your view?
Well, I mean, I've been down at site, and I think that was about 18 months ago, and they have a big resource, Costa Fuego, and it's infrastructurally not challenged. It's a good part of Chile, but it took them 10 years to get permission to take seawater out of the ocean. But their idea was originally, I believe, to feed into a desalinization plant. But then metallurgically, they found that the saline it didn't impact their metallurgy, and they could use direct salt water. It's not everywhere that you could use direct salt water in terms of metallurgy and get as good or better recovery, but that was the case. But as they went forward, what was happening in Chile was they needed all these new desalinization plants. And it was sort of like the independent power producers, where these desalinization plants would have a customer base, and they would build that infrastructure and know that they could sell all that water. But for them to get started, they would have to wait 10 years now to get that permit. And now there's already one out there, so that's valuable, highly valuable. And there's already projects out there that would need that water. And so I think it's a great move, because when I worked there in the 90s, the whole idea was that if you hit a copper intersection, the next hole was for water. And it's only gotten worse. Not only in Chile, but in a lot of areas all the way into the US and Canada.
I spoke to the company here. They said what they will need for their Costa Fuego is 700 litres per second. They've got a permit or authorization for 4,000 litres per second. They estimate there's going to be 32,000 litres per second of demand from the mining sector going forward. All of them would have to take, as you say, at least 10 years to permit their own water solution. So they think there's a bright future for that. Those projects include the Newmont and Teck Resources Nueva Union joint venture, which I think is about 40 to 50 kilometers away. So it does seem to be a very shrewd move.
Yeah, I mean, it is, because I mean, any one of those jurisdictions, you can look around and there's a lot of deposits sort of waiting for more infrastructure. And most of that infrastructure is related. Some of it is power, but most of it's water. And you can't touch the water. Like, I mean, I went to go see a project, Vizcachitas, which is further south. And their whole idea is that they're right up against the Andes. And if you know anything about South American history, San Martin, he crossed the Andes and liberated Chile, going through this valley. And that same valley is where the Vizcachitas project is. And there's water and everything like that, but that water goes directly to agriculture downstream. And so they can't touch that water. So they need to bring up water from a different source. And so that's what all companies have to do. They can't compete with potable water. And especially in a zone of agriculture. And so having the ability to access water, being able to diminish these timelines by having the permit already in hand has definite value.
Also here at the Rule Symposium is First Majestic Silver. They've announced that they're now minting coins and bars from their new mint in Las Vegas in Nevada. The company says it gets paid more money for its silver because there's no middlemen involved. And it said also if it can sell the entirety of its 10 million ounces a year of silver production in this way, it could remove 250 million ounces from the paper silver market per year. The company CEO claims the paper market really suppresses the silver price. Joe, where do you stand on the paper manipulation of the silver price?
No idea. Sorry.
Okay, we're going to fall down on that one. Okay, let's go off campus. Also this week, Metalla announced the first gold production from the Tocantinzinho gold mine in Brazil.
G mining.
Oh, sorry. Contango and Kinross, the first gold pour from Manh Choh in Alaska. And also Contango completed the acquisition of High Gold, also in Alaska. Orezone secured $105 million in financing for the phase 2 expansion of its Bombore gold mine in Burkina Faso, and a construction decision. Joe, while many projects in the Americas seem to be entwined and bogged down in permitting and social license challenges, companies in West Africa seem to be able to just get on with things. What's your view?
It's always been that way. I mean, Burkina Faso, when it was really rocking, you could permit projects very easy, and it was basically a cut and paste on the plant. Everyone knew the type of plant they needed. They could build it really quickly, and so you can come into production really quickly. The problem has been in West Africa has been the security issues, and that's become embedded sometimes in the operating costs for these companies, trying to keep their people safe. When I went to Burkina Faso, I don't know, more than a decade ago, the security was much different from the north of the country to the middle of the country where Orezone was, which was safer, to the west of the country where Rox Gold and Semifo were. And I was up near where Karma was, which is now I think an Endeavour project. That was not good security. I mean, you needed a lot of security. So I think that security thing is still an issue for a lot of these countries in West Africa, which hinders their cost of capital and makes it more expensive for them to get money. And so it's the risk reward. You can get into production quicker, but there's that risk has not gone away. It's anything, it's been festering.
Well, let's close on a bit of macro. A lot of the speakers here have been talking about how they expect the US Federal Reserve to pivot and start reducing interest rates, which should weaken the US dollar, which should be good for the gold price. What's your view of how the rest of the year is going to play out?
So a lot of people at the end of last year were predicting 6 rate cuts. And so they were pushing gold and gold equities at that point. Gold did fine without the rate cuts, only because central bank buying mostly China. But we didn't have that buying. So it was really weird for real interest rates to stay up, but gold was going up. But it obviously didn't help gold equities. And now we only need 1 rate cut basically for the market to be optimistic. And we're giving the US Federal Reserve 6 months to do that. The last signs, and I don't pretend to be an economist, though I actually did take economics at school, is is the fact that we've seen inflation come down, trending down consistently, and now it's really hitting unemployment. And the problem is now then you throw as you would say, a spanner in the works with the federal election, the U.S. elections coming up in November. So it's almost like all bets are off. We don't know what the U.S. Federal Reserve, they might not want to be politicizing what they do and put an interest rate hike in right before the November election. So we might not see one. So there is that risk as well. So yeah, to sum up, I have no idea.
Okay. When will gold equities rebound? Will they?
Ooh, I know the answer. No, I don't. So I would say that if we see the trend for real rates coming down, that will spill over into equities. So in the meantime, what we should look at is keep those high quality assets, because the industry knows that there's a certain amount of time for acquisitions, and that window might shut. If once the U.S. Federal Reserve starts raising rates, these financing windows will open up, and the M&A might get more expensive.
So be positioned, be patient.
Yeah, as an investor, be positioned. Yeah.
Excellent. Well, Joe, let's leave it there. Thank you very much for joining us today.
Great. Thank you very much, Paul.
And I'm Paul Harris, and this is Digging Deep for Kitco Mining.